Here now your closing bell for Tuesday, 20. Ladies' Day on Wall Street. We got some green numbers snapping a 4-day losing streak. The Dow up 92 points. The S&P just barely in the green, but we will take it and look at the NASDAQ by the slightest of margins again with the bleak outlook we've had. My friends, we will take it. For a closer look at the broader markets, let's bring in Barrett Asset Management Chief Investment Officer Amy Kong. Amy, nice to see you. Look, they're very slight gains, relatively low trading, but we'll take it. What do you make of it?
Hi, guys. Thanks for having me. I hear you. It's one of those days where we'll take it after 4 or 5 very tough sessions. And it's really just perhaps waiting for that next data point to come out, which could possibly be PCE numbers coming in on Friday. So perhaps that volatility might start to go up higher by the end of this week.
Amy, what are you expecting to see from that print? And then looking out just in terms of how we will likely trade over the next several weeks, what are you expecting there?
Sure. I think the PCE number could come in very similar to what we saw with the CPI numbers, meaning that there is this peak inflation trend forming. And that hopefully could support the argument that the Fed will likely slow down, not stop, but slow down into 2023 in terms of its interest rate hikes. Coming into 2023, this Santa Claus rally that we've all been waiting for, the chances of that is dimming a little bit. Although I'm not surprised, I wouldn't be surprised, let's call it, to see perhaps the last trading days pick up a little bit. We tend to see that. But then, of course, as we go into the new year, there could continue to be volatility as new calendar year. People could be taking some gains off the table again. And so again, that volatility could pick up as we enter the new calendar year. And so
just to be clear and zero in on what you think the Fed will do, Amy, you think 225s and a pause?
Yeah, I think, right now I don't think a pause is in the cards yet for the next couple of FOMC meetings. Right now, CPI has come down, but it's still very high on an absolute level. And so if that continues, meaning the trend continues to soften, we could see CPI and the Fed funds rate start to meet somewhere between that May to July period. And that could be somewhere between 3.5% and 4.5%. So I think the next couple of FOMC meetings, I think they'll continue to hike. I think 50 basis points may be in the cards for January. We'll have to see what the next couple of CPI numbers come out with.
I mean, there is some concern out there that the Fed has been too aggressive already, that it will continue to be too aggressive, and then the implications from that. Are you at all worried about that aspect of this equation yet?
I certainly am. I think you raise an excellent point. And one of the biggest risks on our laundry list of worries, if you would, is Fed policy error. The Fed uses data points that are somewhat lagging to make its financial decisions or monetary policy decisions. And while, they want to fight inflation, I think it does take time for past rate hikes to really trickle into the system. And the past couple of rate hikes have been very aggressive. So I do think they need to recognize that. So while at the same time, it is tough because you have to balance the fact that if you were to pause or send the wrong message, you can send the markets into some kind of tailspin, and you want to avoid that as well. So I think maybe, that 25 to 50 basis points rate hike going into the next several meetings makes sense. But I think pausing without seeing the inflation data points, I believe that could be an error.
And if they do make that error, where would it be reflected? Where would we see it first?
You'll see it both in the stock market and the bond market. I mean, the bond market is sending a message to the Fed right now that they are probably too aggressive. And you can see that with Fed funds futures. Bond market traders are expecting rate hikes by the back half of 2023. And so there's definitely going to be some reflection there. The stock market will also be very responsive in the sense that, they're hinged on every word Jerome Powell says. And so any error or any, confusion, if you would, in terms of its language, I think the markets will definitely show it through volatility.
So, Amy, what does all this mean from an investor perspective and what people should maybe be prioritizing or buying at this point?
Sure. I think from a stock market perspective, we don't think that it pays to be overly exposed to the stock market at this point. So we are not allocating any new dollars to stocks at this junction. Where we are putting that money is probably in the bond market, and we are starting to see yields pick up. And we're also starting to expect yields to peak sometime in Q1/Q2 of next year. So where we have been hiding in very, very short-term treasuries over the past 12 months, going into the next 12 months, we're actually looking to elongate duration in our portfolios, meaning we're looking to probably lock in some rates, perhaps up to 5 years in maturity, so that, again, if the recession does happen and the Fed has to actually reverse course, we're actually locking in some pretty decent yields going into the next couple of years.
And what's your prediction for equities moving forward in 23?
That's a tough call, right? So, all throughout 2022, we've had a PE contraction, macro conditions causing that, the Fed causing that. And going into 2023, if the P part of the price to earnings ratio is not to move higher because of macro conditions, it's really reliant on the E portion of the PE. And earnings could be at risk going into next year, considering that many of the companies we follow have not yet provided guidance. So that actually would be an important hurdle for us to get through, that we'll obviously see more data in January into February in the next earnings season. And we do expect those numbers to come down. So our outlook going into 23 is somewhat cautious, considering that the earnings portion is likely at risk.
Amy, when it comes to the consumer has in fact been relatively resilient when you compare just in terms of the deteriorating economy, the higher costs, everything that the consumer has been facing up until this point. What is your outlook there just in terms of how much the strength of the consumer might be able to offset some of the weakness that we're seeing more broadly speaking in the economy next year?
Excellent question. I think you're right. The consumer has held up very well. A lot of that is based on two main factors. One is just excess savings from the pandemic, right? The government was basically shoving dollars into our pockets in some form or fashion. And that's is somewhat waning a little bit, especially with some of the lower income earners. I think the other aspect that's been holding up well is wage inflation. It's still hovering around that 5% level and has been able to offset some inflation that we're seeing in the food and energy, at least for the first part of this year. And so overall, the consumer has been holding up well, but we are starting to see cracks. Retail sales numbers are softening. That is a reflection of consumers turning more and more cautious as we head into 2023. And in general, the savings rate as a percentage of disposable income has also come down quite a bit. So what that means is the inflation part from wages has helped, but then people are saving less to, again, make up the other half. And so what we're seeing is savings rate is now down to 2 to 3%, which is somewhat low compared to what we've seen in the earlier parts of the year or even pre-pandemic, which had been somewhere in the high single digits. So I think the consumer is still holding up, but we're starting to see some cracks in the system.
All right, something to worry about here as we enter the new year. Amy Kong, always great to have you. Thanks so much for joining us here this afternoon.